Of choppy market action today, the market has more jitters. And I think that's because we have the PCE coming out on Thursday, the Personal Consumption Expenditure Index, which is the Fed's favorite measure of inflation. And the market is concerned that we may not see as good a decline in the inflation rate as is hoped. So I believe that's what's happening, just hedging against possible news that's not as rosy as expected. Hopefully they're wrong. Hopefully the market is incorrect and the hedging was for naught, so that we can see, and that we do see some major or at least significant improvement in inflation on Thursday. But we shall see. Now, it's been an interesting time. As you know, last week I talked about the fact that we've had a very choppy market because there has been better than expected inflation data for January that came out. There was a little bit better than expected jobs reports that came out for December and January. But at the same time, there's still weakness in the economy with consumer spending sentiment dropping, especially after the holidays, and people saying, boy, we've got maybe too much debt. Part of that is the buy now, pay later phenomenon. Right now, we have a lot of people using buy now, pay later for $250 or smaller purchases, which is concerning to go that small and need 2 to 4 payments to pay for things like groceries that we're seeing in some of these buy now pay later apps. That's a concern. The other concern out there is interesting. Ian Siegel, the CEO of ZipRecruiter, said this, and we haven't seen this reflected the last 2 months, right, in December and January's job reports, but we may soon for February's. We'll see what happens. But he's saying, hey, with ZipRecruiter in 2023, 80% of all the job hiring, the new jobs, were in 3 sectors of the economy: government, healthcare, and leisure and hospitality. So obviously the government's expanding with, tax revenue, et cetera. They've not slowed down, or not even tax revenue, just borrowing more money to fund their operations. They have not slowed down, and they've grown. The federal government has grown, and most states have grown as well over the last year and the last number of months. Well, we're talking about last year here, so 2023. And healthcare, of course, continues to grow as we have an aging population. And then leisure and hospitality are growing mostly, and I read an interesting article on this last week, mostly because of the affluent millennials, for the most part, who just love spending on experiences. And so they are continuing to fuel the leisure and hospitality and travel industries, anything that's connected with this, and entertainment to an extent that's unprecedented, and just will not back off on the spending on that services area. So services remains a sticky piece of inflation. And I'll probably go into more of that, I'm guessing, next week as we see some breakdown in the PCE numbers. But for today, let's take a look and see what's going on with the markets here. As you can see, we have the 10-year Treasury is having some, it's waffling today, right? So we had the yield falling on Friday. That was welcome. And it kind of bounced right back up to this 100-day moving average ceiling of resistance, technically, that we have here. Let's hope it doesn't break through that. We do not want to see the yield continue to rise. That would indicate interest rates are rising. And we want to obviously see what happens Wednesday with the GDP numbers, and then Thursday with the personal consumption expenditure inflation numbers, hopefully are positive. Negative, right? Low inflation is what we really want to see. The UMBS, Universal Mortgage-Backed Security 30-year fixed bond, which is the exact bond that informs what interest rate you're seeing for mortgages, as you can see, like I said last week, has been very choppy, right? And we've been chopping around for 2 weeks, unfortunately heading kind of the wrong direction here as a trend since the end of January. Hopefully that'll turn around again with Thursday's PCE report. But if it's not as good of inflation drop as hoped, as expected, unfortunately, we could continue to see this price go down. As the price drops, of course, as the price drops, of course, you end up seeing the interest rate and yield rise. So this chart is the opposite of the 10-year Treasury yield. So that's what we have cooking today, and just wanted to show you that, share that information with you so you can see what we're expecting this week as we look forward to GDP data on Wednesday and then the PCE on Thursday. If you're not following me on Instagram, please do at the Bill Zimmerman. You'll get more information that way. I share on my stories some highlights about what's going on during the week with regards to interest rates and other economic news, inflation news, all that sort of things, so you can stay in the loop on what's happening. So follow me at the Bill Zimmerman. And in the meantime, have a wonderful week.